Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts.
Well, that's a great point, Steve, and that's why this cycle is just another different context of this cycle than in the past. The reality is that, Europe cannot raise rates. The U.S. can't really raise rates in here, which means some of the major demand drivers in the world, Japan's not going to raise rates for a long time, but these other outside countries that are more satellite countries of China, which is keeping the music going, they're heating up. So you have really a dislocation or disunity, so to speak, in the global economy that you don't normally get. Sometimes obviously people lag coming out of recession, but not only do you see the ability of differences in lag times, you can see the differences in some going south and some going north, in a globalized economy that was supposed to be tied tightly together. So it's a very, very different cycle. We read a good piece the other day, and we tend to agree, because of still the concern on global demand. We saw Larry Summers, the U.S. economic czar, came out quietly and asked Congress for another stimulus package. That goes to the idea that if global demand isn't rebounding, U.S. has to keep rates lower longer. But the idea of the U.S. Not rebounding presents more risk in the world, and that's one of the reasons we think the Australian central bank actually has been on hold here. Usually when central banks start a rate hiking campaign, they hike. They went hike, and then stopped because they're already seeing the few hikes that they made bite into their demand base in a bit because of I know I'm going on and on with this answer, but the fact is it's quite complicated. It's quite a different cycle than it has been in the past. So you're right with your question. Sorry about that. I kind of rambled.
No. Thank you. I just thought about that. I guess earlier today. It just doesn't seem like in the past that central banks would be acting in unison, especially like you said. They tell us that we're in a globalized world. It doesn't seem like it. At least they're not acting like it. Hey, Jack, would you please give everybody your email, because we're getting a lot of comments about the article.
Sure.
Is it info at Black Swan Trading? Is that the best place to get it?
Info at blackswantrading.com.
Let me just
info at blackswantrading.com.
Jack, why don't you take a moment while I type this in, and just, if you have any closing comments, please just take some time. Talk about what you thought, and just to summarize your view of the euro here.
Yeah, I would just say, even if the euro, even if they do get their act together, so to speak, it's advantageous for the eurozone to have the euro go lower and lower in here, because it increasingly takes pressure off. So one way or another, we think the euro is going lower. The only question we have in our mind is it going lower a whole lot faster? Or is it just going to continue to spiral down as Europe muddles through? Because remember, currencies are driven ultimately, after we do all our analysis and play all of our games, there's really only two fundamentals that carry the day longer term in currencies, and that's yield differentials, interest rate yield differentials, and relative growth rates. So if you look at the Eurozone compared to the U.S., ultimately, because of the European Central Bank now taking on quantitative easing in a big way and having to provide liquidity to the zone, they're not going to raise interest rates. And if the globe does grow, we think that the Fed is going to raise interest rates much sooner and faster than the euro. So you're going to see the yield differential go positive pretty quickly, and the expectations rise for a rising positive yield differential for the U.S. dollar compared to the euro. And global growth differentials we think are going to widen once we get through this risk period, because we see very strong export growth in the U.S. to the emerging market areas. So on both yield and growth, we think that even if the euro stays intact, we think the U.S. is going to really trump the euro in a very, very big way. So that's our view, even if the breakup doesn't come to pass.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.